Hello everyone. Today we start a new chapter, the chapter number 10, the stock and their valuation. As we learned before, the value of bond is quite straightforward because there are only two types of cash flows, the fixed amount of coupon payment and face value. A value of preferred stock in US also simply calculated using perpetuity formula. In this chapter, we are going to learn the value of stock. There are two types of stock, the common stock and preferred stock. In rest part, we will learn the market equilibrium. There are three ways to value the stock. The first method is the dividend growth model, and second model is corporate value model. We call these two discount cash flow methods. And the last one is matching method. It means using multiples of comparable firms. Today we are going to run the dividend growth model. Let's start. This slide shows the dividend growth model. In the last chapter, we run the value of financial assets. Value of financial asset can be calculated by present value of future cash flows. In the stock valuation, the payment is dividend. So D1, we can say dividend at time 1. There is one assumption about dividend. Stock valuation assumes we cannot use dividend before we sell the stock. So dividend cannot be reinvested. So we can say the value of stock is present value of future dividends. What is N and what is maturity for stock? Before we sell the stock at time N, we don't know the N, right? This is not helpful to our concern. So we just assume that we don't sell the stock. In this case, N will be infinite. So we can write down N is infinite. How this RS is determined? Do you remember in the bond part, RD? How RD is determined? Do you remember? RD is determined by the three components, right? RRF, the risk-free rate, plus DRP, default risk premium, and MRP, right? And RD is used as discount rate. In stock valuation part, RS is calculated by theory. We will learn this chapter about the risk and rate of return. So we can write down that this comes from theory, the chapter number 8, the risk and return. In this chapter, we just assume it is a given number. Before we run the constant growth model, let's start with the preferred stock's valuation. And what is preferred stock? Preferred stock is kind of hybrid security. What is hybrid security? Hybrid security means it has both characteristics, the bond and stock. Preferred stock is like a bond, receive a fixed dividend, and it is the kind of stock, right? So it can enjoy the upside potential of the firm. And preferred stock must be paid before dividends are paid to common stockholders. So it has priority. However, companies can omit preferred dividend payments without fear of pushing the firm into bankruptcy. So it is not an obligation. As you can see in the timeline, there is a fixed dividend and it has forever. And G equal to 0. What is G? G is dividend growth rate. What does it mean? Dividend growth rate is equal to 0? Yeah, it is fixed, right? 0 means fixed. So this kind of dividend stream would be a perpetuity. In Korean, 영구연금. Do you remember how can you calculate perpetuity? The value of perpetuity? Yes, we learned at this slide. The value of perpetuity can be calculated by PMT over I, right? So in this case, dividend and R is the discount rate. So in this slide, the PMT is dividend. What is dividend here? Yeah, $2, right? So $2 and R is here, right? It is given number. So you calculate this 2, you get the $15.38. So we can say the value of the preferred stock is the $15.38. In this case, it assumes dividend does not change, but it is a very strict assumption. Now we are going to do restrict this assumption. Dividend grow at a constant rate. A constant growth model assumes dividend growth will be stabilized. So dividend grow forever at a constant rate G. So the G is dividend growth rate, and in this case we assume it has constant rate. Constant. So it is G, a specific number. So let me draw a timeline. Zero, 1, 2. We have an infinite number, right? So there is no end. So we get dividend D1 here, right? T1 and D2, and we get the numbers. And dividend grow at some constant growth rate. So D1 can be interpreted as this: D0 multiply 1 plus G. So we can write down D1 is D0 multiply 1 plus G. What is D0? D0 means dividend at current time. But as you can see, we cannot see D0 in the timeline. So now we want to calculate the present value of all the future dividend, right? That means the value of the stock. So how can you calculate? Yeah, using just discount method, right? So P0 hat, yeah, we don't know the price. The D1 is D0 1 plus G, right? And the discount rate is RS, right? So 1 plus RS. And the second one, D2, right? D2 is D plus D multiply 1 plus G power of 2, 1 plus RS power of 2, right? Because it discounts 2 times, 1 and 2, right? And we have infinite number Dn and 1 plus Rsn. How can you calculate this equation? Do you remember the sum of an infinite geometric series? Maybe you learned in the high school. In Korean, 무한급수의 합. Maybe you learned in the 수학의 정석, right? According to the sum of an infinite geometric series, the equation is here. 1 minus r, the numerator is a. So in our case, the P0 hat, what is r? R means a common factor, right? So r is, in this case, 1 plus rs, the numerator is 1 plus g. Yeah, this term multiply each terms, right? So we can write down 1 plus g over 1 plus rs. And what is a? Yeah, a is the first term, so here, right? So we can write down d0 1 plus g, numerator is 1 plus rs. So the denominator, we can rearrange 1 plus rs, 1 plus rs, minus 1 minus g. And the numerator is 1 plus rs, d0, 1 plus g. And then we can cancel it out, right? And this can be cancelled out. So finally we get rs minus g, d0 multiply 1 plus g, right? And this is the same with this. Yeah. So we get the general formula of the constant growth model. You should know is there is one required condition in the sum of an infinite geometric series. This r should be less than 1. So r should be less than 1. So in this case r is 1 plus rs. The denominator is 1 plus g. It should be less than 1. And we move this term to right hand side and then get g should be less than rs, because these two are cancelled out. What does it mean? It means the growth rate is less than discount rate. This is an additional assumption of constant growth model. So this graph shows the future dividends and their present value. And this is RS, right? So as I mentioned before, G should be less than RS. It means the growth rate of dividend is less than discount rate. Because of this condition, even if G keeps increasing, present value of dividend keeps going down. What happens if G is higher than RS? It means what happens if dividend growth rate is higher than discount rate. In this case, the constant growth formula cannot be used. So the constant growth model can only be used if the dividend growth rate is expected to be constant forever and dividend growth rate is less than discount rate. This is one example. How can I get these numbers? This number comes from D0 multiply 1 plus G, right? And D0 is 2 and 1 plus 0.06, right? Because constant growth rate is 6%. And then get these numbers. And this number also comes from D0 1 plus G power of 2, right? And how can you get this number? This number 2.12 1 plus RS. RS is here, so 0.13 power 1, right? Discount only one time and get this number. And you can apply this method to here and here, right? And as you can see, the numbers goes down, right? It decreases. Why? As I mentioned before, G should be less than RS, right? In this case, what is G? G is constant at 6%, and RS is 13%. So when the G is smaller than RS, the value of dividend decreases. So n goes to infinite, dividend converges at some number, not explode. So now we can apply the constant growth model. Using constant growth model, we can input the numbers, right? The D1 is here, right? And RS is here. And G is here, right? G is constant 6%. So when you input the numbers, you get these numbers, 13.29. That is P0 hat. What does it mean, P0 hat? P0 hat means intrinsic value. This is a true price, not a market price. Intrinsic value in Korean 내재가치, and we also call this fair value. Fair value or fair price. Fair price in Korean 적정가치. What is the purpose of calculating this number? Why we calculate this number? It means compared to against one number. This number compared to this. This means market price. So the current market price is lower than intrinsic value. In this case, intrinsic value is higher than P0, right? It means stock is undervalued or overvalued. Which one? Undervalued. In this case, buy or sell? Buy. Because this stock is undervalued, so in some times later, this price can go up to the fair price. The opposite case, if the market price is higher than intrinsic value or fair price or fair value, we call this overvalued and not buy. So if you have this stock, you should sell, right? Because the price goes to intrinsic value. It means price goes down. What is expected market price of a stock 1 year from now? So let me draw a timeline. the 1 year from now and 2 many years, right? And we stand here now. So now we want to know the expected market price 1 year from now. So P1 hat. Yeah. Great. Using constant growth model, the denominator is same, right? The numerator only change. So rewrite this equation. D2 can be calculated by D1 multiply 1 plus G. And this part was what? RS minus G1, the numerator D1, right? This is P0 hat. But in this case, we already know the number P0 hat because we stand here, right? So we cannot take hat. So finally, this equation can be right P0 multiply 1 plus G, right? So P1 hat can be calculated by two ways, this way or this way. The second way is P0 multiply 1 plus G, right? What does it mean? This means expected market price of the stock 1 year from now can be determined by the dividend growth rate. That is the conclusion of this slide. What are the expected dividend yield, capital gain yield, and total return during the first year? There are three types of return. The first one is dividend yield, second one is capital gain yield, the rest one is total return. Do you remember in bond valuation chapter, we already learned this kind of return? Yes, this slide. As you can see, the current yield of bonds can be calculated by annual coupon payment divided by current price, and capital gain yield can be calculated by change in price over current price. And these two, the sum of these two, we called yield to maturity, and we can say that is expected total return when you hold the bonds. Apply in stock like this. The yield to maturity can be calculated by CY and CGY. So CY is dividend yield and CGY is same, capital gain yield. We say this is total return of stock. One different thing is in the bond part, the current yield is annual coupon payment over current price, right? But in this case, not a coupon payment, we have dividend, right? So dividend yield. Dividend yield can be calculated by D1 over current price, right? And D1 we already calculated at this slide. Here, right? D1. And P0 also we already calculated. Here, right? So after calculate this, you get the 7%. So dividend yield is 7%. And what about capital gain yield? Capital gain yield is same. The current price is denominator, and change in price, change in 1 year from now. How can you get this number? Yeah, we learned at the previous slide. Here, right? Yeah, P1 can be calculated by current price multiply 1 plus G, and then we get this number. So input this, and we already know P0 and P0. here, and then get the 6%. So capital gain yield is 6%. And one interesting is the 6%. Do you remember what is 6%? Here, G is constant 6%. Yeah, CGY, the capital gain yield should be same as growth rate of dividend. So we can say this question mark is G. Why? From this equation, we can write as this. The P1 equal to P0 1 plus G, and rearrange this. G is equal to P1 over P0 minus 1, right? And it is rewrite as this, right? And it is the same with this equation. Yeah, so capital gain yield, we can say it is same with dividend growth rate. And next, the total return. Total return can be calculated by two components, the dividend yield and capital gain yield. The dividend yield we already calculated here, right? The 7%. And capital gain yield is here. And it also same as the G, so 6%. So finally we get this number, 13% when we hold this stock. One more interesting is this number we already showed. Do you remember where is this number comes from? Yeah, here. This RS was 13%, right? It is same with the total expected return. Why? Total return should be same as RS. RS can be interpreted as a required rate of return. This is kind of total expected return. These two should be same. From the equation of this, P0 is D1 over RS minus G, right? And RS minus G is equal to D1 over P0, right? And RS P0 D1 plus G, right? What is this? D1 over P0 is here, right? Dividend yield, and dividend yield here, right? No, here. And G, where is G? Here. Capital gain yield is the same with the dividend growth rate. So we sum of these two, we get the RS. It is same with total return. We will learn more detail in the market equilibrium part.